All right, welcome everyone. My name is John Vance, president and founder of Vance Wealth. Today is our mid-year market and economic update. So we are in July 2022, and we're just going to give an update on where things stand today. And I'm kind of excited to do this mid-year. I've been doing annual mid-year updates for over 15 years. I think it's been just a valuable use of time as a firm to provide updates to our clients. Especially, I think a lot that might be on this webinar are a little bit more dialed into the day-to-day of what's happening in the financial markets. So those that are tied in and really want to know what's going on economically and in the market, we're going to give you those details. And we're also just going to cover some big picture ideas. So I hope you enjoy this. And again, I'm more than happy to answer questions as we're going through some of our topics. So here's just our disclosure page. One of the things is we're going to go through a lot of charts. Most of the charts that we have are going to be sourced. And so, you'll be able to reference that as we kind of make our way through if you want to know where that data is coming from. All right, well, let's just jump right into it. So, a lot of the questions we've been getting from clients, clearly there's been a big pullback in the financial markets. We've seen asset values come down, statements, your 401k balances are down, your brokerage statements are down. We've seen losses pretty much across the board all year. And so it's been a rough start to this year. Now that has been on the heels of 3 really strong years. So the reality is we know markets go through these types of ups and downs, and that's not going to change. But one of the things I've been really kind of, I guess, getting into the weeds with clients on is really understanding, well, what's causing this? Clearly we have, potentially a recession on the horizon, or maybe we're in a recession. We have higher oil prices. We have geopolitical issues around the globe. There are things that are out there, but I try to kind of narrow it down as like, what's really the biggest driver of what's happening today? And I kind of came up with this, this thought process around, essentially, if we went back about 9 months, we had a bit of an asset bubble, meaning prices of everything have gone up. Prices of bonds, prices of real estate, prices of stocks, a lot of the prices of things that we consume. So I think if you kind of walk away from this update, the reality is now that we're using hindsight and say, okay, well, how did we get here? I think the short answer to that is the Federal Reserve created this asset bubble. And here's essentially how they did this. So I know I have to warn you ahead of time as you're doing these mid-year annual updates. I do get heavy into the weeds of what's going on because I think that charts obviously can explain how things are happening, why they're happening, but oftentimes we can get kind of caught up in a lot of the minutia here. But I'm going to do my best as we go onto these slides, because we have quite a few to explain some of these concepts, is to make sure I walk you through, well, what's here. So what we're going to start with is the Federal Reserve balance sheet, because I do believe the Federal Reserve primarily is what has caused this inflation, this asset bubble. I think there was reasons for them to do that, COVID being the primary driver. But nonetheless, I think they are the largest culprit of why this occurred. Now, we all have the benefit of looking in hindsight and evaluating decisions. Whenever we have the benefit of hindsight, we're all brilliant. None of us have a crystal ball, so it's fun to look back, even if we can identify mistakes, because I think that it does shed some light on why things are happening the way they are, but also kind of what to do about them, what to learn. So what we're looking at here is a chart that goes back to 2003, right? So it's almost 20 years of data, and it shows the size of the balance sheet. So the balance sheet for the Federal Reserve basically is kind of another way of essentially printing money, right? The Federal Reserve can print money and put it into the economy. And if you look back in 2003, the balance sheet for the Federal Reserve was less than $1 trillion. And then we hit the financial crisis in 2008, 2009, and that jumped up to 2 trillion, right? So it jumped up pretty fast. That was a massive move. And then as we kind of made our way through, the Federal Reserve continued to stimulate the economy. And you can see the different types of assets they were purchasing. Treasuries, you see on there, it says MBS, which is the dark blue line. That's mortgage-backed securities. Well, we've been living in a really low interest rate environment. We've all benefited from it. Many of you on this call, if your mortgage is not already paid off, you actually have really extremely low rate mortgages, maybe in the twos on 2.9, 2.8, maybe 3% of a 30-year fixed mortgage. Well, one of the big reasons why you were able to lock in those low rates is the Federal Reserve was using printed money to go buy mortgage-backed securities, and by buying them, they drove interest rates down. So many of us benefited from this. Now, when we kind of look at the far right-hand side, we can see the year 2020, and that shows the massive jump up due to COVID, due to the shutdown in the economy, where we actually went from 4 trillion and hit a peak north of 8 trillion. So literally, if you think about the Fed's balance sheet, this wasn't a thing 50 years ago where the Fed would be printing this kind of money to really kind of stabilize the economy. But the reality is that's part of their playbook now, and that's probably not going to go away anytime soon. So when you look at this, you can see the massive amount of money that went into the system. And at the very end of the day, inflation is caused because you have too much money chasing too few goods. So because the Federal Reserve basically pumped $4 trillion into our economy, it has now caused inflation. Now, the reality is, if you look on the very far right, it shows forecast that the balance sheet is going to start coming down. That process has already begun, and we think inflation is going to likely start to come down with it. But that is, in my opinion, been the biggest culprit. Now, the idea of printing money is very foreign, right? It's like, well, how does it get out there? Well, it's basically because the Fed is putting this money into the system by being a buyer, by being an investor. They're buying government bonds, they're buying mortgage-backed securities, and they're doing so to help keep the economy growing. That was the big driver of why they did it in COVID. Frankly, they should have stopped some of this activity about a year ago when inflationary signals started to pop in, but unfortunately they didn't. They let this go on longer, which in hindsight was a mistake. But I also think at the time there was enough data that they should have started to change course, and they didn't. So given that that's the backdrop, I think this is one of the big reasons why all this started. The reality is many of us benefited from our home prices going up. Many of us benefited from the stock markets going up and our 401ks and everything going up. So while it didn't feel bad up until a year ago, right? Because we were benefiting from these higher prices, it feels bad now because we're going through a correction. So I'm going to walk you through just some of the data on some of the other markets so you get a little bit of understanding of where we are. So there's a lot of data on here, but this basically shows, as of last Friday, where the major markets are. So the S&P 500, the Dow Jones, the Russell 2000, which represents small companies. So I'm just kind of going down this list of equity markets. Russell 1000 growth companies, Russell 1000 value, which is really large value, large growth. And then you can see there's 2 international indexes. So it just kind of goes through all the data of what's happening. If you look at the 5th column over, it says YTD, which is year to date. So the S&P is down 18% year to date. The Dow Jones down 13% year to date. The Russell 2000 small cap index down 22%. Large cap growth is down 25. Large value down 12. A couple of the international markets down 20. And the NASDAQ, which is tech dominated, is down 26. So the worst performing is obviously the tech dominated sector. And then if you look at the very far right, which says three-year cumulative, that actually represents the total return over the last 3 years. So even though it has been pretty bad this year, the 3-year numbers for the US market still look pretty healthy. And that's one of the things we have to remember as an investor, is the reality is we're investing over a long market cycle. There's going to always be choppy 1-year data, year-to-date data, but we also want to look at how did we do over 3 years? And that's where the numbers are more promising and kind of, I think, help us keep an eye on the reality that, we're long-term investors. We have to kind of take the ups and downs, but we're looking at making, nice returns over a longer period of time, 3-year, 5-year, 10-year. The chart below kind of dissects the US market. On the left-hand side, these are known as Morningstar style boxes, and it represents percentage gain and loss in different parts of the market. So you can see the bottom left corner is small value companies, down 15%. The bottom right corner is small growth, down 27. So you can see value companies this year have actually done substantially better than growth. Growth has been the biggest winner over the last 15 years, but is going through some tough times here with some of the volatility. And if you look at on the far right on the bottom, it represents some of the industries and some of the sectors of the markets. So you can see energy is really the only positive performer, and it makes sense, right? Oil prices have spiked, prices of the pump are higher, energy companies are doing well. I think I saw, I read somewhere that even though the energy companies are positive this year, their 10-year performance is basically zero. So this has been a very unprofitable asset to be in, but is doing the best this year. And then you can see some of the other names as we go through. So just wanted to share with you kind of where things stand. It's more of just here's where we are. Let me see if I have a question that I can. So I have a question from an anonymous attendee. When looking at the Fed balance sheet, does that mean the Fed owes $7 to $8 trillion? I guess owes is an interesting way of asking that question. Technically, they don't owe it to anyone. When you think about they're essentially printing money. They're going to buy assets on the open market, right? So it's basically fake money. So I guess technically you could say they owe it, but they don't really owe it to anyone. And it's the capability of the Federal Reserve to kind of print money to stimulate the economy, to keep the economy moving forward. But it is a form of debt, yes. So who they owe it to is kind of an abstract concept, I guess we could, because it doesn't factor into like our overall debt as a country. This is a totally separate entity. But I guess technically, yes, it is owed. To whom is the magic question, because it's not really a to whom. All right, let me see. Yes, it is a liability. So, all right. So let me move on. All right, so I'm going to go through a couple headlines. These are not fun headlines. So this was the worst start to a year for bonds and the third worst start for stocks. And so it's pretty remarkable. So when we look at this data point, let's see, how far back do we go? I believe this data point goes back to 1926. So a pretty large time frame. So if you look on the left-hand side, it shows some of the total return numbers for the markets. And so you can see 2022, the first 6 months, bonds lost 10%. So one of the hardest things with diversification for investors is the reality that bonds are known as a safe haven. They're known as a store of value. Bonds aren't supposed to lose value. Well, the reason they lost value is because the Federal Reserve was so active in buying bonds. By buying more bonds, it pushed interest rates down. Well, now that interest rates have gone back up, it's causing these losses. And so these losses are now behind us. We don't believe they're going to persist, but the reality is it's been a really painful start, one that essentially nobody's seen. We haven't seen these kind of losses since 94, going back 30 years, and then 1974, which goes back almost 50 years. But then it does show you, well, what does the next 6 months look like historically? Well, in all cases, returns tend to be positive. So it depends how you want to look at it, glass half empty, glass half full. The bad news is behind us. What does it look like on a go-forward basis? And if we look at the right-hand side, the third worst ever start to a year for US stocks. So third worst. 1932 and 1962 were worse. And then you can see 2022 down 20%. Well, if you look historically, when we start off in this negative manner, the next 6 months tend to be pretty good. Now, I'm not going to spend too much time on this because I have a lot of supporting documents that kind of show when you have a bad 6 months or a bad year, the next 6 months tends to do pretty well. So I have plenty of slides that are going to kind of walk through some of this data. So not great news when we look at it from an investor perspective. One of the things in reality is, as your financial planner, we're going to be evaluating it. We're going to be evaluating how it impacts your overall financial plan. But the reality is the pain that we just experienced is where we are today. The question is, where are we going? And that's where we want to, because that's what we're trying to accomplish, obviously, as an investor, is we want to make returns on a go-forward basis. What had just happened is nice to review, but there's not much we can do about the reality that it's been a really tough year for an investor. And obviously, if you've been in cash, you haven't had these losses, but we've had inflation, which is eroded away some of that purchasing power. So as we get into, let me see if I have this. Okay, so this is just this shows that we're in the worst 3-year period ever. So not only was this the worst first 6 months that we've ever seen, this is the worst 3-year period for bonds ever. And you can see some of that data there. So it shows data periods like 1980, 1957, 1981. So it shows some of these periods of time where we've had losses on a 3-year basis. And then you can see the return characteristics on a go-forward basis have been relatively positive. Because of, so that just gives you a sense of, we don't have negative years for bonds very often. And think about that. This has been the worst 3-year average return, and it's down 0.9% per year for 3 years. So while that is painful, we got to realize that bond volatility is not designed to be as volatile as stock market volatility. So even though it's been a painful 3 years, it's still not the kind of volatility that we can expect in the stock market. All right, so I have a bunch of a couple I guess nationwide real estate stats. These are through, a couple of them, if you notice on here, are through June, some are through April. Just depends on when the data comes in. Actually, we have one through May. So I'm going to kind of unpack each of these. So obviously, we're seeing real estate starting to slow. As of, when I did my webinar over the last couple of months, the housing market hadn't really shown signs of slowing. We are now seeing the signs of slowing. And I've been pretty adamant that stocks have adjusted, crypto is adjusted, real estate really hasn't. Well, that's starting now. So if we look in the top left-hand corner, one of the big drivers of why the stock market, or why the real estate market is starting to show some signs of weakness is just the fact that mortgage rates jumped. If you see that chart, it goes back to 1982, and if any of you bought a home in the early 80s, you had a double-digit mortgage, but we've all been accustomed to being in a pretty low interest rate environment, mainly getting mortgages in the 3, 4, and 5% range. And so the average interest rate on a US mortgage jumped up to about 5.5%. We hadn't seen that level in over 10 years, actually closer to 15 years. So that's obviously putting some pressure, right? Because interest rates go up, that brings down or it makes a home more expensive in terms of the monthly payment that a homeowner would have to make. So that's also pulling some of the pricing back. It's causing homes to stay on the market a little bit longer. So we think that trend's going to continue. And if we look on the right-hand side, housing inventory. So one of the things that's really interesting is that the headwind that we're seeing is that rates have gone up. The headwind that we're seeing is that now mortgages are a lot more expensive, which means if you buy the home, it's going to cost you more every month. So that would kind of, in my mind, give us a red light flashing of be cautious about being an investor. But then you look at the chart in the top right corner about housing inventories, we're at extremely low levels, right? We know that we have a shortage of housing, especially in LA County, but we're having a shortage of housing all over the country. And so that actually helps to maybe counteract the fact that interest rates are going up, is the fact that inventories are still low. Demand might still be there. Now, we do see demand starting to wane, it's starting to slow, but this is this is actually healthy. The fact that housing inventories are lower, that should help keep prices stable. So when people kind of ask me, like, what do I think is going to happen with housing prices? Well, let's look at this chart in the bottom left. So this shows home prices. So what we're looking at there is on the left-hand side, it shows percentage increase on a national basis of home prices. And then it shows the year. So we're looking at 1988 all the way up till current. So you can see this doesn't go in a straight line. We all remember, many remember the real estate bubble back in the late 80s. Then you can see, the decline in real estate prices. And then we went through the financial crisis back in 2007 through 2009, where real estate prices declined in value. And then you can see what happened in April of this year, where real estate prices were up 20% year over year. So we obviously saw this massive spike. So what our estimation are with home prices is the rate of appreciation is going to slow. If I'm here a year from now doing the same talk, I think that we'll probably be close to the 0 line or maybe the 5% line. I don't think we're likely going to go negative. I think it depends on the neighborhood, but I think we're going to kind of hover in this 0% growth for the next 3-4 years as we start dealing with these rate increases and the impact on the average home buyer. So not dire for residential real estate, definitely a slowdown, but I don't think we're going to see prices come way back, except for, maybe if you look on in your neighborhood, that last house that sold at the very top, it might be hard to get to that price, but not many people paid those extraordinarily high prices. And so just be mindful of that. But we definitely think residential real estate is lagging. Back in 2000, in the financial crisis, just to give you a little bit of color, and you can see this on this chart in the bottom left, is that the stock market bottomed in 2009. The real estate market did not bottom until 2012. So if we go into a recession, whether it be mild or severe, we don't necessarily know when the stocks have bottomed because we just don't know. We'll know in hindsight. But the real estate market tends to be a little bit of a lagging indicator. So we do think some of the slowness or weakness in the real estate is probably going to persist. But I don't really expect the kind of correction that we saw back in 2007, 2008. Big driver is because there's not a lot of inventory. So that's a healthy sign. All right, well, this is a cryptocurrency market capitalization. So market capitalization basically represents, if you added up all the cryptocurrency out there in the world, how much was there? Well, back in early 2021, there was only $1 trillion. I know I say only $1 trillion, but there was $1 trillion. At the peak last November, we got to almost 3 trillion. And now essentially we're back below 1 trillion. So we've seen this crypto asset bubble kind of build and then correct. And frankly, again, it's kind of back to the same thing with the Federal Reserve pumping so much money into the system. People have just been, buyers of these types of assets and somewhat being, pretty speculative. But again, the Federal Reserve, with their actions of, printing all that money and now starting to contract it, they built this asset bubble, and now this asset bubble is coming back. And it happened fast in crypto. It happened fast in stocks. It's happening a little bit more slowly in the real estate side. So I think it's by design, even though it's painful, we're living through this. We kind of have to just accept that that's the reality, is because of some of the action that was taken, we're now undoing this. So that kind of addresses where we are from a current market environment. Questions that we're getting constantly is around inflation and interest rates. Where are things going? So I want to just go through some headlines and also just kind of really cover some of the areas that we think we should be aware of in terms of where are interest rates headed, where's inflation headed. And while when we start looking at making predictions, we definitely don't have a crystal ball. We do have opinions on where things are going to go, but only time will tell. It'll let us really know and be aware of where things are going to head. But these are the headlines that we're seeing right now, right? The Fed sets biggest rate rise since, it's kind of blocked here, 1994, right? So that's a massive headline. And one of the things that I would caution all of our investors on this call is, like, the newspapers and the media love to scare you, right? So it's always the biggest rate, or it's the worst period of time. So, we love to see headlines like this. I don't love to see them. The media companies like to see these to create some fear and some action. But yes, the Federal Reserve is raising rates. I do think there was sleep at the wheel a year ago. They should have raised rates starting a year ago. They did not. So they're playing catch up. So that's just the reality. This next slide shows the history of interest rates. This goes back to 2000. And so this shows the Fed funds rate, which is what the Federal Reserve controls. And then remember, the Fed funds rate is what drives other rates, like the prime rate of interest, like the mortgage rate. So these are all kind of factors of the Fed funds rate. And so if you look at this chart, we had rates back in the early part of this century, right at September 11th. When September 11th hit, we saw rates come down. Then we saw rates go back up, and then we had the financial crisis, and they crashed down, and they stayed at zero for so long. And then you can see they started moving back up in 16. So the important part of this chart is basically, where are we today? And this is 2022, which is on the far right-hand side. Where are we with current rates? And where's the market expecting we're going? So if you can see the colors that are played out, right now the federal funds rate's around 1.65. And then you can see the direction that the Federal Reserve is expecting they're going to go is in dark blue. The green represents market expectations. So what are investors telling us? And then the purple represents the Federal Reserve's long-term target. Where do they want to be? So right now we're about 1.65. So we know rates are going to go up. There's been some talk of 0.5, 0.75. So the interim target here is that that rates make their way up to about 3.4%. And that's pretty much what the Federal Reserve is predicting, as well as market expectation. What's interesting on here, Federal Reserve is predicting that rates stay longer or higher a little bit longer, and the market's actually forecasting that we might be going into a recession, and that's going to cause rates to go down. So the reality is the Federal Reserve is trying to do two things. They're trying to control inflation, which they're struggling with, which is why they're kind of in a panic and they got to raise rates. And they're trying to have full employment, right? They know to have a healthy economy, you got to have price stability and you got to have people working, right? So the working component, the unemployment rate's actually in a really healthy position. They're just battling this inflationary pressure, which is caused by a lot of different things. So The reality is I kind of side with the market expectations. I do think we're probably going to be slipping into some a slowdown. We, again, technically might be in a recession here. The GDP numbers for the economy are going to be published on July 28th. So we'll have a little bit more clarity, but nonetheless, if we're not officially in a recession, we do think we're just gonna have a slower economy for the next 12 to 18 months. And that's why some of the market interest rate expectations are, yeah, we're gonna see this bump up here so the Fed can get the inflation rate under control, but then we're gonna normalize kind of closer to their longer term target of like 2.5%. This is just a reminder of like historical interest rates. And I know if I, especially, I've, younger clients, younger employees, when I define younger than me, and they look back and, look at this chart back, it goes to 1958, and then look at where interest rates were. So the dark blue line shows what the 10-year treasury was. And then the gray represents real 10-year treasury yield. And that basically will show real, meaning after inflation. So you can see like the peak of interest rates was September 30th, 1981, where the 10-year treasury was paying 15.84%. And then you can kind of see where we are today. So this chart goes from 1958 all the way up till today. Because inflation's been a problem for the last 12 months, we are looking at a negative real rate. And that negative real rate of -3% has not really happened many times. That happened back in 1975 and it happened back again in 1981. And just as an aside, not that this is going to happen on a go-forward basis, both of those periods of very low real interest rates was a very good time to be a real estate investor and a stock investor. 1980 and 1981 is a really good time to invest. And so we don't know if past performance is going to repeat, but if it does, then this would suggest that today is not a bad time to invest, despite all the fear that's out there. Another headline that we're getting hammered with, I don't think you can read a paper without getting inflationary articles, right? These inflationary articles are here. They're not going away. We all feel it, gasoline being the primary area that we're feeling it. And you can see, these are some of the changes that we've seen, these consumer price index changes. The 12-month change, gasoline being up 60%, airfares up 34%, household energy up 22%, groceries up 12%, right? So we're all feeling this pain. Well, the reality is, remember, inflation is always looked at on a 12-month basis. So because we've seen these elevated prices, inflation is naturally going to make its way down because we're hitting some of these higher levels, and we're likely going to see it start to trend down. I have a chart in here to kind of go through that, but obviously, it's not good to see 9.1% is what we hit in June. And some of this is the result of the fact that what happened during COVID is we had prices come way back, especially gasoline prices, and now we're just seeing kind of a reset and a push back to some of these higher prices. Just as a reminder, I know there's a lot of data on here, but this shows the inflation components, some of the big areas that have driven these inflationary pressures. So back in March of 2021, inflationary numbers were only 2.6%. And now through May, 8.6, and actually through June is 9.1. And it shows you who the culprits are. Energy is the big one. Then new and used vehicles. If anyone's bought a car, you know what this is like. Food at home, right? We're eating a lot more at home, and food prices have gone up substantially. Others, kind of a large category, restaurants and hotels, shelter, right? So that's obviously rent payments, mortgage payments. And so these are real issues. They're impacting everyone's bottom line. Again, I do think this is going to turn over. I know I did an inflation talk in the last 6 months, and I kind of made the point that I think this is transitory. So, it depends how you view transitory. Transitory doesn't mean it's just going to happen over 6 months or a year. I think inflation is going to work its way through. And after we look back in 18 to 24 months, we're going to start seeing some normalized levels of inflation. This is a chart that came from FactSet, and Raymond James published this, but basically based on the data they're seeing, and you can see this chart on the left-hand side is kind of the potential path of inflation. You can see the dotted line. So the expectation of where we think things are going to go based on this, the kind of the current state of the economy, is that inflation is going to make its way down pretty sharply. Like as quickly as it went up, we think it's going to normalize and make its way back down into the 3s, 4s, and 5s. Maybe not down to the 1s and 2s, which we saw a lot during the last 2 decades. And again, you can see some of and a big driver of that, we think there's some political incentive, obviously, to drive prices lower. We know it's not good for the incumbent president, the incumbent party, to deal with higher inflation, because higher inflation impacts all of us as Americans. And whether it's because of them, in spite of them, it's on their watch. And we all know that's our political system. So there's a lot of political incentive to try to drive some of these things down, drive inflation down, drive gas prices, get gas prices lower, fix the economy, things like that. So we do think that will decelerate. June might prove to be the highest number we hit. We won't know until the next one's published. All right. So after all that, I get to kind of go through, and I don't want to say end because I have quite a few more slides, but when you get these market corrections, part of the positive side is that the negative results have already occurred. So now we get to look forward, and we know when prices drop, there's better value, right? Things become cheaper. So as an investor, we know inherently we want to buy things when they're low, sell things when they're high. So there are reasons to be optimistic. I do think that we're going to have this slowdown economically for a prolonged period of time. Again, I don't know how long, 12 to 18 months is what the data is suggesting. But I do think when we look back, we're going to view this as a shallow, mild recession, not a severe recession. And the big key of why that's why we believe as a firm that that's going to happen is because the employment markets are still strong, and that's going to start changing. We're going to start seeing some more layoffs. But it's going to still stay relatively strong because there's still really healthy demand among a lot of companies. And anywhere you go, people are looking for employees. So let's go through some of the good news. Well, I've talked about this for years. I feel like I might show this chart every presentation that I give. It looks crazy noisy, but it's really easy. So what we're looking at here is, if you read kind of the top, so this is what's called intra-year decline versus calendar year returns. So what this shows us is the gray shows the total return for the S&P 500 in a calendar year. So on the very far left-hand side, it shows 26%. So that means the S&P 500 in 1980 was up 26%. If it could be 79, I think it's 80, but it's kind of right on that edge. Then in the red, it shows minus 17%. So that shows intra-year declines. That means that on the way during the year to a 26% return, the market dropped 17% at some point during the year. So the reality is that despite intra-year drops on average of 14%, annual returns were still positive 32 of the 42 years. So we know markets tend to be up about 75% of the time, down about 25% of the time. And currently, if you see on the very far right, it shows YTD, which is year to date through the end of June. This shows that markets down 21, the intra-year decline was down 24. So, excuse me. So the key takeaway from here is embrace volatility. This is not going away. So that's why I am putting this under the good news. Like, this is not new. As investors, this should not surprise us. I do realize whenever we get volatility, it feels different. There's a different reason. There's a different headline. But we've weathered plenty of these economic storms. We've weathered plenty of geopolitical issues. We've weathered a lot. And so the key is like, embrace volatility. This is norm. It's not fun, but it's normal. And that's really what drives your success as an investor, is being able to handle some of this volatility, knowing that it too shall pass, even when the time frame is uncertain. All right, there's a lot here, but this is probably one of my favorite slides for today. Is this, I believe, is the University of Michigan consumer sentiment. So University of Michigan polls consumers, and they are trying to evaluate consumer sentiment, meaning are they positive or are they negative, right? So one of the reasons why I like this is a counterintuitive chart, which means when consumers are highly pessimistic, which would show at the bottom. So let me set this chart up real quick. So the University of Michigan set up this ranking system, and you can see on the left-hand side, it goes from 40 to 120. And then on the bottom, it shows all the years. So this goes back to 1971 all the way through now, through June of this last year. So basically what this shows us is when there's high pessimism, you're going to be scoring low. So you can see these troughs where back in February 1975, you can see a little blue dot. In May of 1980, there's a blue dot. Where we are on the very far right-hand side, June of 2022, we have a blue dot. So this measures kind of a trough in the consumer sentiment. So historically, and you can see all the data there, when you have massive amounts of pessimism, as investors, you should be bullish. And, it does come back to that kind of this quote from Warren Buffett is, be fearful when others are greedy and be greedy when others are fearful. Well, this shows us that sentiments are really low. We haven't seen this low of a level since May of 1980. And I do believe it's driven based on geopolitical issues that we're seeing, energy prices and the inflation we're seeing. But the reality is if you look at the top left-hand corner, it shows you what is the average subsequent, meaning in the future, 12-month returns of the S&P at peaks versus troughs. And there's been 8 sentiment troughs, and the average return has been 24.9%, which means if you invested at those troughs, on average, you made 24.9% going forward. And at the sentiment peaks, when people were bullish, when people were excited, when people felt good, the rate of return on the S&P 500 on average is 4.1%. So it's a really good reminder of tracking sentiment of all of us as investors or consumers feeling good, feeling happy, feeling positive. That should not shape your investment decision-making because it goes the other way. When you're feeling pessimistic, that's the right time to invest. And when you're feeling really optimistic or overly optimistic, that usually represents a peak, which represents in using this historical data going back over 50 years. It's historically not a great time to invest at these different peak levels. So hopefully that makes sense. I know there's a lot of data points on here, but that's really, this is a good indicator for potentially being bullish on a go-forward basis. Even though I just said economically, I think we're going to struggle. The market's going to be an interesting one, lots of volatility, but I don't think it's time to just shy away and say, I'm not going to invest because there's a lot of risk out there. The reality is you get rewarded over time when you make those decisions. And we don't know what the future is going to be like. So we still want to diversify. We still need to have discipline with our process because you know what, this next 12 months might be different than the past. And that's just the reality of investing is we know that past performance does not guarantee future success, or future results, but we do want to make sure we're mindful of what has happened in the past so that it can help shape the decision-making on a go-forward basis. All right, yield curve. Not going to spend a lot of time here, but basically the yield curve represents at the very bottom, you can see 3-month treasuries, 1-year treasuries, all the way out to 30 years. So this is these are the years on how you could purchase a US government bond. And then on the left-hand side, on the y-axis, it shows the interest rates from 0% all the way up to essentially 4%. So the gray line basically, or it's gray or black, the bottom line basically shows where we were in December of 2021. So only 6 months ago, where we were, and you can see how low interest rates were. And we've all been frustrated by this, right? Our cash is not paying anything. Bonds have been yielding really low. Well, with interest rates going up, now the good news is you're seeing cash rates go higher. Three-month treasuries are almost at 2%. 1-year treasuries are now in the 2.5% to 3% range. So the good news here, why this is a bullish case, is that with some of our fixed income, some of our bonds, we're getting paid double the amount of income. Now, it wasn't fun to get here, but the reality is now on a go-forward basis, this is income, this is yield that will help improve the returns on our safe money. Where the outlook in December of last year was at really low interest rates. And so the return characteristics were kind of destined to be below normal. But now that we've seen rates move a little bit higher or substantially higher, over the last 6 months, it does put us in a better position to get some better returns in our estimation. Again, coming back to some of these long-term things, when you start talking about, our case for optimism, when you take a long-term view, you deal with the reality that markets are going to have ups and downs. Now, again, we don't know what the future is going to hold, so we can't just use this chart and say it's going to repeat itself. But this is a chart that goes back to 1980. And this basically shows that if you'd invested in the S&P, which you can't directly, you can't just buy the S&P index. You can through an ETF, which is similar but not identical. Had you just invested back in 1980, $10,000, through the end of May, your $10,000 grew to 1,157,000, right? That's the whole point of being a long-term investor. That kind of compound growth is far exceeds inflation, far exceeds what you can get in cash. But look at the bumpiness along the way. All of these green dots along the way represent challenges that we've had. You know, 1980, the Fed funds rate reached 20%. 1987, we had the Black Monday stock market crash where the market dropped, north over 25% in one day. 1991, Gulf War. 1994, Fed tightening. 1998, the Russian default and the long-term capital management crisis. You know, and as we go, I don't need to read all these, but you can see those. So we always kind of climb this wall of worry with the markets, but additionally, there's always challenges out there. There's always challenges with the Fed. There's always geopolitical risk. There's market crashes. This is all normal. But sometimes we get so focused on the here and now and we miss the long-term picture, right? So had we known all these things were going to happen in 1980 and been able to look back and say, wow, 10,000 turned into over $1 million, that's 100 times your money from a return perspective. You know, a lot of these challenges that we experience, when looked at in the rear view mirror, aren't really significant. And if you start trying to make decisions based on these items, you're going to make bad decisions. And that's what we really want to avoid. Hopefully that's why you enjoy working with us. As part of our job is to be good advisors and make sure we're giving you good advice to take this longer term approach. All right, this might be the hardest one to explain, so I'm going to do my best. So the data points that we're looking on here basically shows, this is a scatter plot. So I got two. I got the left-hand side is where we were from a valuation perspective back in September of last year. So September 21st, you can see that kind of in the red. On the right-hand side, this is where we are as of the end of June. And I'm going to walk through what this means. I think it's significant to understand this. If you don't understand how all the dots work, that's okay. But I just want to walk through what we're looking at. And so what happened here is this chart goes back to 1997. So it's there, we're looking at about 25 years of data. And essentially what it's doing is saying, okay, what is the forward price to earnings ratio, which means what's the price to earnings ratio for the markets, the S&P, on a forward basis. And I'm going to plot that. So if you look in September of 2021, the PE ratio or price earnings ratio was at 20. Now, the reason why there's a red line showing going up to the chart, what this scatter plot on the left-hand side is basically showing us that in previous periods, based on where the price to earnings ratio was, what were the subsequent 5-year returns, which means actually using hindsight, not predicting the future, what were the actual returns? And if you notice, the chart is slanted this way. So what this tells you is that when you move down to the left, price earning ratios get lower, which by many people, they would argue the market gets cheaper. And when you go to the right, price to earnings ratios go higher, which means that the market becomes more expensive. Now, if you notice, whenever the price to earnings ratio has been above 20, which is where we were back in September, the rates of return. So let me pause here real quick. So as we look at the left-hand side, this shows the rates of return, the average annualized rates of return. So the line that runs right across the middle, the black line, is a 0% line. That means that you made 0% over the 5-year period. So what we're looking at now is that if you see how the scatter plot is slanting, it basically shows you is when PE ratios are high, the rates of returns are closer to that 0% line, and even some that are below. And then as the PE ratios actually go lower, then the rates of returns go higher, right? And if you look at the very far extreme on here, when the PE ratios were in the single digits, you can see there's only two small scatter plot plotted there, and the rates of returns are close to that 20% per year. So the reason why I wanted to show you this is not to make you an expert on that charting, was to basically show you, like, this is how things plotted out, looking at the data back in September. So we could argue now in hindsight, markets were a little expensive because we had a price to earnings ratio of 20. Well, today, which is the right-hand side, June 30th of 2020, the price of earnings ratio is now at 16. So because the market has corrected 20%, now the price to earnings ratio has gone down. So on a go-forward basis, you can see what's been plotted. Historically, that means on a forward-looking basis that returns are likely going to be higher. So I apologize, I probably hurt your head kind of walking through all that, but the long and short of this is that when you have higher returns in the past, which makes the market more expensive, right? We all know that, right? Think about your house, right? If your home price doubles in value in a short period of time, that means the returns going forward are likely going to be lower because pricing has gone up so much, right? We know that high rates of returns are not sustainable forever. So the reality of what we're looking at here is that 9 months ago, markets were a little bit overvalued based on some of the things we talked about, and return outlooks were lower. Now, on the right-hand side, it says, hey, we've seen this correction now. Now the prospects for returns in the future appear to be higher, at least by historical data. So that's another positive thing, is when you get corrections, assets are priced more reasonably, which could mean that returns going forward are going to be better than you would have expected otherwise. So I know this is going to be a hard one to kind of get through because there's just a lot of meat here, but hopefully that made sense at a very high level. And now this is just another chart. So what this basically shows is when we've had large first half declines, how did the markets do? So you can either look at it in two different ways. On the left-hand side, it shows it in a bar chart, and on the right-hand side is basically showing the same data, just in a table. So in 1932, the first half of the year, the markets were down 45%. The rest of the year, the market was up 56. In 1939, down 17, the rest of the year up 14. 1940, down 19, the rest of the year up 6. 1962, down 23, up 15. 1970, down 21, up 26. 2022, we don't know. And then if you look at the table, the bottom right corner, the average during these large first half declines has been about 25%, which is kind of in line with where we are today. And the average recovery the remainder of the year is up 23%. That still does not get you back to even. You will still have a loss if that does occur. I'm not predicting that that's going to happen. But what this is designed to show you is that when you have these large declines, they're usually followed by some sort of relief rally and some sort of strength. So again, looking at some of the positives, given the fact that we've lived through some of this downturn, and a lot of this is just is conveying that, yes, we have a long-term approach, but and we don't want to be making hasty decisions because we're concerned about potentially recession. You don't want to make your decisions based on the economy, which I think then kind of get us into our wrap-up slide here. So, 3 crucial lessons for weathering the stock market storm. And this is obviously something we're paying attention to. That's why you hired us to help manage your money and be a good steward. Number 1, a recession is not a reason to sell. And there's tons of data on this, but the markets usually are anticipating a recession. We are seeing the slowdown that's already occurred. Markets peaked out last fall. And so a lot of the recessionary environment is probably priced in. We might have some more weakness, but it's probably priced in. So it's not a reason to sell. That if on July 28th, the data comes out that we're in a recession, that's certainly not a reason to sell. So that's number 1. Number 2, time the market at your peril. And I remember we had a lot of this during COVID, right? When COVID first hit and we shut the economy down, you couldn't go to work, you couldn't leave the house essentially for that real short window. The stock market got hammered. And a lot of people had the feeling of, okay, well, I know this is bad for the economy to not have the economy open. I know this is going to be bad for stocks. So why don't I just get out of the market and wait? Now, fortunately, we didn't have clients that did that. We stayed long-term. We stayed disciplined to our process. But the thought process around it is I want to wait till it gets better. Well, the reality is the stock market and any financial market is a forward-looking mechanism, meaning they're trying to predict the future. So by the time the bad news is now hitting, kind of the warning sign and flashing the red light, the markets have already probably moved down. And then the flip side is there's no such thing as the all clear bell that just says, hey, everything's great now, get back in the market, because reality is the markets anticipate that. So if the economy starts to improve, the markets are going to move ahead of this. And so that's why trying to time the market is just not valuable. You have to do it through asset allocation, diversification, and have discipline. And then if you look at this chart on the right, it's kind of showing some of the same data that I've illustrated on a few different slides, a little bit different way of doing it. So a little bit of a longer term approach, because I think that's actually a lot more valuable. So what we're looking at here is Fama French put this data together. They're researchers out of the University of Chicago, I believe. This data goes back to 1926 through the end of last year. So we're looking at 3 columns, and it says, okay, if I have a certain level of a decline, how did my money perform 1 year later, 3 years later, and 5 years later? So when you have a 10% decline, you can see on a 1 year basis up 12%, on a 3 year basis up 34%, and on a 5 year basis 68%. And then you can see, well, what happens after a 20% decline, right? 22%, 41, and 71%. And then a 30% decline, then you can see the returns on a 1, 3, and 5. And so it just shows you that it pays to stay invested even after some of these declines. So we went through a 20% decline. I believe the NASDAQ hit about a 30% decline. So this is just, again, some more evidence of showing why it's important to stay disciplined, to stay invested, even if the economic news keeps getting bad. Even if, as I'm doing webinars, I'm kind of reporting some of the bad news, that still does not change the desire to be an investor and be more disciplined and more, and kind of more resolute on why you're an investor, because the long term over time is where you get all the benefits from being invested. And then number 3, it may be a good time to reassess your portfolio and your plan. Obviously, our clients, we've been rebalancing accounts, reviewing your financial plans, making sure your plans are still healthy. If you are joining us as a guest or a prospective client and you want to reassess your portfolio, your plan, let us know. We're here to help. All right, so I believe that is it. So, we always offer free consultation. So anyone not a client would like to, take us up on that offer, please either visit our website or go ahead and click on this QR code. Just as a reminder, our next upcoming webinar, I don't have a set topic, but I do believe what we're going to try to do is get questions ahead of time from many of our clients and guests that are attending and prepare for them in a thoughtful way. So if you have any topics, I think we're probably going to send it out via a survey. We're probably going to have a little bit more economic and market focused as well. That's subject to change, though. As we get topics that are coming in, we might just generate a theme. But our next webinar will be Tuesday, August 16th, same time, 4:30. I hope this was valuable. Please feel free to share this, as we get this out to you via YouTube and also through our email. So hope you enjoyed this. Let me just check a couple of questions here to see. Okay, I have one question here, and I know we have some people that are falling off, but how much does the increase in minimum wage and gas price affect inflation? I think, Wally, I would probably just be speculating if I just kind of threw a number out there. I mean, clearly wage prices do cause inflation. Gas prices affect inflation. I mean, those are two big drivers of that. On some of the earlier charts, it showed that the majority of or a big chunk of the inflation was actually due to energy prices, or more specifically because of gasoline price increases. There wasn't a lot of data on whether it was minimum wage or even wage increases. There still has not been a tremendous amount of wage inflation, especially when you take into account just regular inflation. So I don't have any data on the minimum wage. There has been studies done in the past, but a lot of the inflation we're experiencing today is not attributable to that. We're seeing the two big drivers, obviously, are energy prices for multiple reasons, right? We have the economy that was growing, and then we have the Ukraine-Russia conflict, which has spiked prices. And then the other part is the supply chain disruption that's impacted cars, that's impacted food supply, a lot of different things. So those are the two big factors that have really driven this recent inflation. And at the end of the day, it comes back to where we started, is the fact that the Federal Reserve printed so much money, it just exacerbated these issues. And so hopefully we're going to get a reset and, get us back on track. Hopefully this recession is shallow. And if it's a little longer, that's okay. I do believe, and many of you heard me talk about this, I do believe if we go into a recession that's a little bit more prolonged than we think, this can be the first recession where people really, if you want to work, you can get a job. As painful as some of this might sound, is you can go get a job at Uber, you can get a job at Lyft, you can deliver food with DoorDash, Grubhub. This is going to be one of the first recessions that we go through, that if you truly want to work is going to be plentiful for those that are going to get out there and hustle. And so it's going to be an interesting dynamic that, recessions are challenging for everybody, but it's going to be in an area where people are going to be able to be a little scrappier and a little bit, they're going to have that ability to actually do okay, even in a recessionary environment. So thanks for all your questions. I hope you enjoyed this. And again, think about stuff for next webinar. If you have some specific topics that we haven't covered and you want you want us to cover that, please email the team. We're also going to be sending a survey out likely to get some feedback from you. So again, thank you. Have a great night.